This is TreppWire Week in Review for week ending September 10th. I'm Mike Benz with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm filling in for Martha Kocher, who's on a much-needed vacation, and I'm joined by Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. We had a short week this week after the Labor Day holiday as most kids headed back to school. Weekly jobless claims posted a steep drop to 310,000, which is a new pandemic low, but the 10-year Treasury yield rose with higher than expected wage growth. The European Central Bank announced this morning that policy will remain unchanged, but they will taper bond purchases with rising inflation. The Fed's Beige Book says there was an economic slowdown this summer due to the Delta variant. Manus, tell us what this means for us.
Thanks, Mike. A couple of programming notes before I get into some of the economic data. I wanted to do an early shout out this week. I know that if I didn't do it right away, I would forget about it. And I certainly didn't want to do that. This weekend is the 20th anniversary of 9/11. For those that are of my age, chances are you knew somebody that was in an office that day and lost somebody or knew somebody that lost somebody. So I wanted to use this opportunity to just, express our gratitude to first responders and the fire, police, EMT, the military. Can't say enough how grateful we are to your service and your courage. I was watching some of the footage this morning and it just all came back to me, even 20 years later. So I just wanted to take that early shout out. I know we do shout out first responders quite a bit here, but in my estimation, you could never do it enough. Moving on to the economic news, there was really nothing good to come out of the last 5 or 6 days. Friday morning, after we had broadcast last week's podcast, we saw that really abysmal jobs number. The jobs number at 235,000 was about a third of the highest expectations or estimates and about half of the lowest estimates of 500,000. So it was dismal even across the most conservative pundits. So that was a real, kind of kicking of the sand, if you will, at investors. But even more troubling probably was the wage growth element of that, as Mike referred to. Wage growth was up 0.6% month over month, which was several factors higher than what people had been expecting. It underscored once again the concerns for inflation that have been on investors' minds for quite a while. And that was the beginning of 4 or 5 days of really, disappointing news. 10.9 million job openings was almost 10% above estimates. As Mike mentioned, Beige Book anecdotes were generally negative, and the ECB announcing what was a very modest tapering this morning, but it was a reminder that tapering here in the US is probably in the offing. And beyond that, tax hikes in all likelihood. So not a lot to hang our hat on this week, and the markets reacted accordingly. Every day for the US stocks, either flat or down for 4 consecutive sessions. The losing streak accelerated on Thursday, and bond yields did spike, as we mentioned earlier, the first couple of days this week, although they did turn around slightly towards the end of the day today, thanks to the really successful 30-year auction. So disappointing week ahead of a stretch that a lot of analysts are expecting potentially a sell-off in the stock market.
Can I go out on a limb here? Will you allow me to do that, Manus?
Let me say that without Martha and without Haley this week, we have Mike behind the mic and Catherine behind the glass. We have every opportunity to go completely off the rails. We kind of went off the rails last week to a large extent. We don't really know how much Mike and Catherine will reel us in. So go to town.
Well, here's the thing. I think I stopped listening a while back, so I never know how much Haley actually cuts out. So for our really loyal listeners, maybe one day we'll splice together a cutting room floor episode, but we may get in trouble if those tapes are leaked. So Catherine, our lives are in your hand here. I was having this feeling at some point over the weekend. I actually texted you, Manus, about it, and I said, it feels a lot like, well, in some ways, it feels a lot like the end of 2018 when we had, that 15 or 20% sell-off for a couple of months. That was another taper tantrum that started back then. And we have, in my opinion, which counts for almost nothing, but I'll just put it out there, we have all of the makings of a sell-off in the equity market, I would say. everything that you just mentioned, Manus, right? Wage inflation, supply chain constraints, huge bounce back quarters early in 2021, post-COVID, that will probably subside in the next several quarters and probably have some tough comps, quarter over quarter on the corporate earnings side. ECB tapering, whether it's a lot or a little, the word taper gets people worried. And just the idea that interest rates have nowhere else to go but up. I just get this feeling that there's lots of fear of a capital gains regime change, epically low confidence in, the current president. I mean, we saw those polls come out recently. Like, no matter what your politics are, if the country doesn't believe the guy in charge is doing well, that's bodes not so well for the market itself. So all of these different factors kind of coming into play with the wild card of COVID numbers coming back up and shutdowns, back on the table and all those types of things. I just feel like we've got some potential issues here. Granted, every time I've said this in the past, if you had sold, you would have missed out on tons of gains. So I could be totally wrong.
Well, I'll agree with some of what you're saying, and I will caveat some other things. I think the one part of the market that is being really, really dismissed at this point is the higher tax regime. We have mentioned it in the past, this possibility for 5 or 6 levels of new taxation, right? New capital gains tax, higher income tax, higher corporate tax, higher estate tax. You could see a multi-level resetting. I don't think the market has really priced that in yet. Somebody this week, I forget who it was, I think it was a woman in Barron's, was talking about how before the Trump tax cut of 2017 or 2018, nobody really believed it until it was right on the precipice of being signed. And this person was saying the same thing with tax rates, that everybody knows it's out there, it's kind of in their peripheral vision, but it's not really front and center at this point. The moment that becomes front and center, I do think you see this big sell-off at that point. The other side of the coin for me is that anytime everybody's calling for a sell-off, and we did see it from Morgan Stanley and Goldman Sachs and others this week, when everybody's piling into the sell-off trade, a lot of times that means you have room to run, right? It means you have a balanced market at that point. It's not, when you really have to be scared is when everybody and their brother and the shoe shine guy are bullish. That's not really the case right now. And as we've learned over the last 30 years, some of these exuberant periods can extend for a long, long period of time, like they did during the dot-com period or 05 to 07 with the real estate market. So, I do believe a correction is coming, but if it doesn't come for a year, that wouldn't shock me, right? I don't think it necessarily has to come in 6 weeks.
Yeah, and I'm no monetary policy expert or macro economist, but on the other side of the equation, that's something I've been thinking about. Actually, I was thinking about it when I was getting ready to teach last night. So I want to touch on that later, the back to school thing. But the epic levels of money supply in the market, as well as the concept of just the supply of capital, is so large. If you think of just a classic macroeconomic supply demand curve, the price of that capital is, of course, going to be lower than if the supply was not as high. So the price for 10-year money is not nearly as high as it once was because the supply of that type of capital is so plentiful. And there is a demographic element to this as well, which is that the boomers, okay, boomer, Manus, right? If I want to sound like a cool millennial, are not retiring as fast as was expected. They're continuing to make money and continuing to accumulate, and they're not really transitioning their stock holdings into, bond holdings and everything else. So like they're still looking for returns and putting money to work like throughout the market. So I don't know if I'm making sense, but the supply of capital is so plentiful that the cost of that capital can't really rise that fast, because if yields went up by 25 basis points or 50 basis points, billions of dollars flow into that asset until the yield comes back down. Same thing with the market. Market goes down by 5 or 10%, billions of dollars flow in to kind of bring it back up. So,
and not all corrections are corrections per se. a slowdown or a recession can result in 3 or 4 years of flat growth, right? The stock market just treads water, which is losing compared to historical averages, but it's not a 20 or 25% sell-off. And to your point, Joe, when you have so much capital out there and people so willing to buy the dips, it probably lends itself to the kind of expectation that a correction of any measurable size will be shallow, not deep. There are things that could set us off the rails, geopolitical matters, a higher than expected tax compromise where the tax rate is much higher than people think right now. Or as one of our listeners wrote in who said that, the black swan is the Delta variant, that's way too underreported and way too a risk to the economy than anybody sees right now. All of those could make my punditry sound silly 6 months from now, but we'll see.
Joe, what's the over under on how many of your students will be tuning into the podcast tonight?
It better be 34 because there's 34 of them in the class. And I made sure to tell them that they better be listening. Even if they're not listening, they better be subscribing, unsubscribing, resubscribing, downloading, and playing them. I should have put it in the syllabus as like an extra credit assignment and dropped some Easter eggs. I'll say that, I was on campus yesterday for the first time in over a year because I took last year off. I didn't want to teach via Zoom. It was really nice. It was really great to be back. Just like when I went back to the office, it was really great to be back kind of in the swing of things, seeing real human beings, walking. I was on Eddie's parade, looking back at Keating Hall and the beautiful, September day. And it really felt good to be back. And I will say that the butterflies that I got, before the class started were significantly higher than they've ever been. And that's, again, because I've been stuck in my house for a year and a half and getting in front of 35 kids who all look at you and think you're a boomer, that can be somewhat intimidating. So it was a lot of fun talking a lot about time value of money and yields and securitization and all that stuff. So really glad to be back.
I always picture you being the Harrison Ford from Raiders of the Lost Ark and a young lady being in the front row with words written on her eyelids.
Yeah, it's usually like, I'm so bored.
Manis, let's transition to office. There's a concerning office trend that we heard about using data from Castle Systems. Can you talk a little bit about that?
Sure. This came via a Wall Street Journal article in the last couple of days. Maybe some of our listeners saw it. It was really some disappointing numbers coming out of the office space in terms of physical occupancy. Castle Systems is an operator that measures in and outs of offices via a key card type reading. They collect data along those lines. Physical occupancy in July was 35%. Not great, but considering we were probably still 2 months from what was predicted to be the Labor Day opening, right? It's probably met expectations. I think that they were surprised, and other market watchers were surprised that physical occupancy dipped in August. I think they were expecting to see companies ramping up, having kind of transitional teams going back, getting the offices ready. Instead, occupancy nationwide went from 35 to 33%. In New York, physical occupancy 22%, San Francisco under 20%. Both of those numbers mimicked what happened nationally, which was down a couple of percentage points. Not a great story heading into the Labor Day weekend. And interestingly, the story quoted the Durst organization, which is heavy in New York City office. They said their August occupancy, physical occupancy, was 25%, which was down from 35% earlier in the summer. And going back to earlier conversations we've had, this is not a problem for the office owner per se yet, right? They have 10-year leases, and unless they have leases expiring this year or next year, or maybe even in 2023 or 24, this is not an immediate problem, right? These are not credit issues. The law firms, the banks are going to continue paying their leases. So that's not the issue. Unless it's a credit problem, there's no issue. The bigger problem is for the retailers, the restaurants, the bars, et cetera, that they were counting on this surge in September. Those that have been hanging on, looking for a new bounce back, something that would fill the restaurants up or their cafeterias, whatever they have, the luncheons. And now you have to think that that's very much in doubt. And kind of breaks my heart, honestly.
Yeah, and I saw another FANMG stock story out, another shoe to drop out of that group of companies, Microsoft. This is from a Bloomberg article. Dina Bass writes that Microsoft scrapped plans to fully reopen their offices by October 4th. They're not even giving a date for a full return. They're saying that they're going to go with the guidance and they're going to give their employees a month heads up when they're ready to return. In a complimentary note in the story, they talk about LinkedIn, which is owned by Microsoft. LinkedIn is adding some features that will allow users to filter roles or job postings based on in-office versus remote. So, they're leaning into this work from home story. And I say it every week, and I'll say it again. You're right, Manus. It's not a problem for an office landlord right now, but a lot of those 10-year leases were made 8 years ago, right? Or 9 years ago. And those are the ones that you really have to worry about, especially the ones that have leases expiring a month before or a month after their 10-year CMBS loan is maturing, right? So there's a lot of equity built up in these offices, especially, office loans that were done post GFC, which is most of the ones that are outstanding now. So they were pretty conservatively underwritten. So maybe the problem is not as big as we think it is, because there's a lot of cushion there. But, I have to think that this is going to be a long-term concept. Just anecdotally, I know of people at Trepp and at other companies that are just happy to stay home, happy to continue working from home, not really dying to get back to the office, and I think that that's a large proportion of the population. And that's going to, especially in such a tight labor market, who is, Microsoft to say you have to get back to the office when this developer can go work for Google or Facebook and work from home, so the talent pool out there is so competitive that it's going to be hard to force people back to the office.
Yeah, a mitigating factor on these leases that are expiring in 2021 or 2022 or even 2023 is that they were leases made coming out of the great financial crisis. And hopefully, in many cases, they are leases that were made at 25 or 30% below 2019 asking rents, right? So if you have an owner of a building in New York that had leases in place in 2012 at $70 a square foot, and the market ran up to $100 a square foot, but is now back to 70, that's not a fatal blow, number one. And number two is, chances are that, if they have to refinance, they're going to refinance into something which is a 3 handle, right? A 3% loan, not a 6% loan. So there are mitigants out there. And with that, we'll run into a couple of green shoots that we saw this week in that space. Let me start with this one, Joe, to get your take on this, probably the greenest of all shoots. Columbia Property Trust being acquired by PIMCO for almost $4 billion. Columbia owns Class A offices in some of the cities that we're talking about that are iffy right now: New York, San Francisco, Washington, D.C. And this one's not iffy. This has been a juggernaut. Boston. Columbia Properties has 7 million square feet.
Yeah, so I think it's a different story, but it reminds me of that Boston Properties story that we had a couple months ago, that they were raising another couple $1 billion fund to invest in Class A primary gateway city office markets. And it just goes to show you, despite all of these potential issues, again, going back to our theme from the beginning, there is so much capital out there chasing yield that, PIMCO is able to put this much money to work by scooping up a nice portfolio of offices there. So I'd love to dive a little bit deeper. I might have to I'll take a look after the episode, dive a little bit deeper on kind of what the premium or discount or what the NAV was that Columbia was trading at, and what they ended up getting purchased for there. So maybe do a full Columbia property cap rate analysis there, and we'll come back to you next week.
Can we talk about the office experience for a second? This week, you and I were in the office at the same time for the first time in 2 years, right? And from an efficiency,
it was terrible.
From an efficiency standpoint, I was able to walk over to your desk, tap you on the shoulder, and ask you 3 questions that took the place of 3 Zoom meetings. How great was that?
It was extremely efficient for you. Yeah. No, I joke, I kid, but it is great, right? I think we only had like 7 or 8 people in the office that particular day. And I did have similar 30-second conversations with 3 or 4 other people throughout the day. And it is amazing to not have to send a Slack message and then text the person and say, did you see my Slack? And then have that person say, yes, set up a call, and then look at their calendar and their calendar is not open for 3 days. So there is that element of it. And we've talked about it many, many times, but when I leave the office after a full hard day of meetings and work and everything else, I am tired, but I don't feel like mentally completely collapsed. Whereas when I get off this podcast recording, I am going to feel like my brain is a dustbin of just death. That's how I feel after a full day of Zoom. So the real life interaction, kind of energizes me, whereas this Zoom stuff just kind of takes it right out of you. So definitely happy to be back.
How do your slacks look, Joe? Do you go pleats or plain front, and do you have cuffs at the bottom? Is that what you're having Mike check out?
I like to steal them from Kohl's and rip off the security tags, and then I just color in with a marker my underwear so that you can't see through the hole, or you don't notice the hole.
Right.
I learned that from somebody I once knew.
Yes, if you listened to our episode a couple of weeks ago, that would be it. Let me run through very quickly a couple of other green shoots and our must know. I'll try to go very quickly because we've spent an awful lot of time on office here. In New York, one of the areas that we are concerned about, the owner Paramount Group has signed 280,000 square feet of leases at 1301 Avenue of the Americas. That's in Midtown West. 170,000 square feet went to Credit Agricole. Another 112,000 square feet went to SVB Leerink. That story comes from Globe Street. In Chicago, Sterling Bay sold a Fulton Market building in Chicago. The building is the home of Google Cloud. The sale price of $168 million was the second largest sale in Chicago this year. Why is this important to me, this sale? Class A availability in that submarket, 54% availability in the Fulton Market neighborhood, and yet Sterling Bay is able to sell off this property. That story comes from The Real Deal. Lastly, something that we had in our TreppWire this week, this comes from ROI, New Jersey. They reported that Infinity Biologics signed on for 200,000 square feet in Piscataway, New Jersey, where the Nets used to play, at the Middlesex Science Center. Why was this story important to us? Well, first of all, it's a CMBX loan, CMBX 8 loan, number one. Number two is the building lost AT&T as a tenant. A couple of years ago, AT&T had 40% of the space. DSCR went under 1.0x after AT&T vacated. Now that new lease will push occupancy back up to 92%. So 3 real nice green shoots. And then with that, we'll go into our must know.
I just wanted to mention one other thing, kind of a follow on from something we talked about last week in the office space. Manus, you brought up that story about the Exchange in San Francisco, which is a very large office building. And we don't have to go through the whole details here, but this is why I love Twitter. So we were kind of speculating there was a large tenant, I can't remember who it was it Dropbox or something like that, who had gone dark and were looking to sublease their space or something to that effect. And we were kind of talking about how interesting it was that the loan got done, even though this was known and stuff like that. And there are a lot of these anonymous Twitter accounts that seem extremely well informed. So I'm always happy to hear from them. And one of them, Private Eye Cap or Private Eye Capital, responded to one of our tweets about it, saying that this was known, when the deal was done, when KKR purchased the property, and they had planned to convert it to a life sciences office building all along. And we got into a deeper conversation in the DMs, where it all goes down, as everybody knows, about how, life science office is on fire, and that just kind of a little bit more broadly, the Class A and Class A plus space is still in extremely high demand. And it's the B and C stuff that is what should be, what we should really be worrying about. So thanks to Private Eye Cap. Hopefully he's still listening out there.
The must know of the week. This is kind of a worrisome picture, we're going to put out a piece on Monday morning for our paying clients on TreppWire. This one from the St. Louis Post-Dispatch. You can find this online right now if you want to see the story yourself. They painted a really troubling picture of downtown St. Louis, the office market there. The piece starts by noting that several large employers are considering moving out of the business district. And this was the really unbelievable piece of the story for me, that the windows had been shot out like by guns of 4 separate offices in that area, in that zip code this summer. The article singles out Peabody Energy as one of the firms considering a move out of the area. In our piece, we flagged 2 specific loans that are in that zip code that we think are ones of concern, either because they are hotels that are already struggling or have near-term lease expirations. But the must-know of the week is, if you are a portfolio manager, you may want to look up these couple of zip codes. If you're a Trepp subscriber, use the Trepp loan feature to see where these zip codes are. There's a lot of multifamily there. There's a lot of office there. There's a lot of hotel there. Knowing your risk is important. If you're looking to pick something up on the cheap, especially in terms of rent per square foot, and you're a contrarian, there's probably deals to be had in this part of the market right now if you want to go in the opposite direction and you're willing to install bulletproof glass, of course.
So we're going to head on over to hotel. And before we jumped on the podcast, I looked at the TSA checkpoint numbers comparing Labor Day weekend this year to 2020 to 2019. And I was shocked to see that the checkpoint numbers for 2021 were only about 10 to 15% off the checkpoint numbers in 2019. 2020, they're way off, 75 to 80% lower. But this past weekend, there were a lot of people traveling. What's that mean for the hotel space?
They must all be going to Vegas. That leads into our first story here, which comes from, by the way, of Bloomberg and Seeking Alpha, that Blackstone is apparently shopping the Cosmopolitan, which is a 3,000 room hotel casino resort. They had purchased it, I believe, from Deutsche Bank several years back after Deutsche Bank had put a bunch of money into building the thing and then kind of got wiped out and didn't make their money back. But Blackstone, as per usual, doing a nice job here. They are looking, apparently, according to the story, they're looking for $5 billion for this hotel. They had bought it for $1.7 billion in 2014. They had actually looked to put it on the market or looked to sell it in 2019, but that didn't go through. Why is this interesting? Well, it's interesting just because it shows you that Vegas, post-COVID, hotel, resort, casino, et cetera, is still, we don't know if they're going to sell it for $5 billion, but I assume that they'll get somewhere around there. That's what, 2.5 times what they bought it for a few years ago, 3 times. That's an incredible number, right? So a couple of things about the actual property itself, or the loan, I should say. Did a little deep dive. So there's a $1.38 billion CMBS loan on this, and it backs a single asset, single borrower 2017 securitization done in 17 when they purchased the property, or I guess they purchased it in 14, but this was a refi done in 17. And it was due to mature in November of 2019, but it had a bunch of extension options. So right now it's in its second extension option. So the current maturity date would be November of this year. It has in total about $1.8 million in debt on it if you count the 3 mezz pieces. But just to give you a sense of kind of where the market is in terms of interest rates, the debt service coverage ratio on this property, based on the trailing 12 months performance ending in June of 2021, is 6. That's SIX, 6. So why is that? Well, it's 2 factors. One is it's had a somewhat of a rebound from 2020 numbers, 2020 full year, where they had 103 million in NOI. Now it's at 192 million. So it's like a really nice rebound in terms of probably RevPAR, not so much occupancy, but their food and beverage and everything else is up pretty good from 2020. But the other part of the factor here is that LIBOR is on the floor, and this is a floating rate loan. So we were doing the math here and kind of checking this DSCR number, and it's actually seemingly right, because LIBOR is so low, and the spread on this loan is only, to be exact, if you want to look at the prospectus, it's 1.93894469565217, in case anybody's interested. I just found that kind of hilarious that they had like 15 decimal points in the prospectus.
It sounds like a number that only Las Vegas can produce.
That's right. So anyway, we'll see if this actually goes through at this level. It had been appraised at 2.9 billion in the end of 2017. So I guess that's an incredible green shoot for Las Vegas in general.
That and the Raiders Stadium is opening.
That's right. I saw some good comments on Seeking Alpha. Now, comment sections can be pretty wild, but I think there were some people talking about how crazy this is and how it's bad and whatever. And there's one guy saying, you're predicting the demise of Las Vegas as I go to events at Allegiant Stadium, Golden Knights hockey games, the new Circa Resort, new Resorts World Complex, Madison Square Garden Sphere, supply chain buildings being built in the area, data centers being built, et cetera, et cetera. And he actually mentioned, this is David, whoever that is, on Seeking Alpha, which is a good point to bring up. The only real issue that they have to really be thinking about for the long term is water, right? And that's maybe something, maybe we can do a deep dive on water, no pun intended, at some point in the pod.
Well, I'll be able to scout out the lay of the land next week. I'm going to Las Vegas a week from tomorrow, restarting up about a 15 or 20 year tradition of going with guys that I grew up with. I was thinking about checking out the Cosmo just to get a real lay of the land, maybe go see a show there, but all they have is Death Cab for Cutie and John Legend. I'm thinking that might be a no-go for me. I might have to look for something a little bit different out there.
You like Death Cab. I thought you liked Death Cab, no?
We'll see. I'm more of like maybe Chicago. Maybe I'll go see Chicago out there. I've never seen them. I'm more of a horn guy.
Is Lady Gaga still doing her show with Tony Bennett? That one I would totally go to.
I did see that, although Tony Bennett has announced his retirement. He's off the grid, though they did recently release a new album, the two of them. And I did get a chance to see her Tony Bennett show 2 years ago, which was just extraordinary. So more hotel stories. We'll throw a couple of other green shoots your way. Thanks for the update on Cosmo, Joe. This one comes from the Tampa Bay Times, I believe. The Westin Tampa Waterside on Harbor Island sold for $67.5 million. This was interesting to me because the buyer paid 60% more than the property sold for in 2016 when it went for $42.3 million. The property did have about $17 million in upgrades over the last 5 years, so that contributes to some of the valuation, but a good sign for that part of the market. Another one in California, Santa Barbara's luxury Hotel Californian, not to be confused with the Eagles album Hotel California, was sold to the Foley Entertainment Group. This comes from KEYT out in California. The 121-room hotel is near the Santa Barbara waterfront. So a couple of nice deals getting done there. And we'd love to see that Cosmo deal get done because that would be another piece of evidence of the hotel rebound.
Turning to retail, the UK saw retail sales increase 3% in August. What does that mean for us here in the US?
Well, it's been a terrific earnings season for retail, as we've kind of documented over the last 3 or 4 weeks, really across the board, other than things like Dollar Store and Dollar General and Five Below. It's been across the board, right? General retailers like Walmart and Target, department stores like Macy's, just really start to finish. Kohl's was another one. Across every spectrum of the market, you've seen wonderful advances. I think the best of the gains are probably behind us for reasons that Joe mentioned at the top of the podcast, things like the annual comps being a little bit more competitive going forward. Last summer or last Q3, we were at kind of a trough of new COVID cases. People were optimistic about the vaccines coming out. So earnings probably for Q3 will look good when they come out in a couple of months. So I think the big gains are kind of behind us, but I do think that absent a colossal reinstitution of lockdowns nationally due to the Delta variant, I think what we're seeing in Europe is probably what we'll see here, right? Low single-digit growth.
Yeah, we did see the consumer spending kind of plateau, right? At least the last month or two. I would expect that to kind of stay the same, right? I don't think we're going to have the crazy growth that we've had early in the year, especially with the fact that more and more states are turning off the additional unemployment checks. The stimulus checks are no longer coming, although the child tax care credits are coming. And it's back to school time. It's back to real life time. I think people are starting to spend money on other things like traveling, like you mentioned before, Mike, with the TSA numbers.
Yeah, we do have a big number coming out tomorrow, which will go a long way, towards finishing the inflation picture, which has a lot to do with how much people are comfortable spending on retail goods. BLS comes out with its PPI for August tomorrow morning. The forecast is for a 0.6% monthly rise, which would be, pretty significant. Core PPI is expected to be 0.5%. So, I think supply chain issues and inflation go hand in hand for what we're going to see on the retail spending side. And if we keep putting up huge numbers on the inflation side and we continue to have supply chain issues, right, production issues, the two do go hand in hand. Of course, one causes higher prices. Then I think that retail sales number surprises to the downside. Right. I think that if we can kind of get by some of these issues, we muddle through with maybe a better number than what they're seeing in Europe. The one story that I don't love, although it's consistent with a narrative that's been in place for quite some time, Brookfield is looking at taking a very big loss on a Fifth Avenue retail condo at 530 Fifth Avenue. They are selling it for $190 million, which is 36% less than what it sold for 7 years ago. Tenants in that property, it's not exactly a murderer's row of Gucci and Victoria's Secret and Apple Store, that type of thing. It's a little bit pedestrian. It's Dwayne Reed, the drugstore, a Chase Bank, and discount retailer Five Below. The buyers are Aurora Capital and hedge fund operator Edmund Safra. This comes on the heels of Vornado a couple of weeks ago announcing that it had sold 5 struggling retail properties, primarily on the north end of Madison Avenue. Those at a $7 million loss. So it is part of this narrative that street level retail is kind of a mess, probably the second worst part of the market after department stores and B and C class malls in the US. So this underscores that story.
I may be wrong here, but I think when I was seeing this story in the Twitter sphere, that there were some tweets from back in the day when they put Five Below into that building and how that's an indicator of where high street retail is in Manhattan. You're not used to seeing a discount retailer on Fifth Avenue, right? It would be like seeing Kohl's on Rodeo Drive. Right. It's kind of like, it's just an indicator that it's not what it once was in terms of the cachet of the tenants,
Yeah, I think that's true. And I think it's a trend that is unlikely to reverse itself anytime soon.
All right. We have some shout outs. William W., I think your view of the office market you express on this week's podcast is spot on. Fully get that CEOs want people to work in an office environment again, but there are too many office jobs that can be completed off campus. Todd O reached out to us, big fan, and just finished listening to this week's podcast. Couldn't help but think of Manis's manicure story and the possible pun opportunity of Manis cured manicures. Sign me up for one of those. And Mark T reached out. He's very much enjoying listening to the podcast every week. No need to send him a t-shirt. We already sent him one last year.
Now that's an honest listener right there. I think Mark T was the one talking about, a serious rebound in COVID cases as the next catalyst. So we love hearing from everybody. We love hearing everybody's thoughts. We know as much as we know. We see things through the data that we see and the stories we read, but I feel like we get so much more value from the listeners a lot of times than maybe they even get from us. So we really do appreciate it as usual.
We do get invites periodically that we take up of people where we'll go out and meet somebody for a cup of coffee or a cocktail after work or something like that. But if you're thinking of inviting me for a joint manicure, it's not going to happen. Coffee, yes. A cocktail, yes. A dinner, a round of golf, all those things I'm up for. Manicure, not so much.
A pedicure, definitely. Although I don't think you want to see that.
No, nobody wants to see my gnarly feet. With that, I want to offer this up as the shameless plug. Next week will be our 100th episode. Hard to believe. One lucky listener will have the chance to win two TreppWire Pod t-shirts. So we're looking forward to having that. We have a special set of things we're going to go through next week. We're looking forward to it, and we're very excited, and we're honored by the tens of thousands or hundreds of thousands of listens we've had over the last couple of years. We'll run down some of those stats next week, and very exciting stuff. And as Joe mentioned, we're humbled and honored by all the feedback we get each week.
Guys, we have to talk about the NFL. We're literally hours away from kickoff for Thursday night football here as we kick off the NFL season. Productivity numbers in offices are going to drop everywhere as fantasy football owners spend countless hours trying to take home this year's office trophy.
In home offices.
With that being said, what's your guys' projections for NFL teams this year? I think we already know Manis's, but Joe, what do you got for us?
Oh no, I'm more interested in hearing Manis's prediction. Every year it's so prescient.
It's so spot on.
Yep.
Well, for those that go way back, they know this, that we started writing TreppWire in 2009. And I think since then we've written about 10,000 credit stories, and I think it goes to about 5,000 readers every business morning, and I think probably twice that many once a week. But I start every NFL season by saying that, as I've said for every year since 1972, I'm predicting that the Giants will win the Super Bowl. I was right 4 times. I'm hoping to be right a 5th, but that's my prediction every year since I was 9.
I'm not necessarily rooting for it, but maybe in some ways I am. I'm looking for a repeat from your boy TB12 down in Tampa. I think that would just be a great storyline to watch.
I thought it was great this week that he was really complaining. I don't know if you guys saw this, that the new rule in the NFL is that players can change their number from week to week. And it's not just that they could change their number, but tight ends always used to have numbers in the 80s. And now they can have any number they want. They have a kicker number if they want. And I think it's been really messing with his head that all of a sudden he's expecting the fullback to block the kicker. And here comes the kicker who's not 140 pounds, he's 290 pounds, and he's ready to drive 1,000 pounds of force on Tom's 45-year-old shoulder.
He'll be having Michael Strahan and Justin Tuck flashbacks.
There we go. So, I think maybe guys like me and you, Joe, we have a place in the NFL now. We're numbers guys. Maybe they need somebody barking in Tom's headset, kind of saying, watch out for the kicker number over on the right end. He's not a kicker.
He also was complaining about the rules that have helped the offense, which I thought was pretty interesting. So, but anyway, that's enough about football for the day. We got
to hear from Catherine and Mike. Go ahead, Mike. Let's hear your forecast. And then Catherine, with her first time behind that glass, we got to let her spread her wings a little bit here and let the audience know what she sounds like.
Yeah, I don't want to jinx it. For years, people asked me who I root for. I would say the Bills, and nobody was ever mad at me. They felt bad for me. And only recently, people would ask that question. I tell them it's the Bills, and I'm starting to get some snarls and some looks, and the fair weather fan, that kind of stuff. I don't know. Without TB12 in New England, the Bills are now a real contender, and looks like they have a decent squad up there in Buffalo. I know my friends at M&T Bank would agree with me.
Josh Allen is tall. That's true.
Manis, I think I'll stick with you. I'm a Giants fan. Hopefully the Giants can bring it home, at least in the next few years.
Catherine, I got to say, you're going places.
Okay, with that, we'll close. Thanks to our producer, Catherine Connor, who's subbing in for Haley Keene this week. Join us next week as we review what's happening during the week and how it may be impacting you. If you have any questions or just a comment, send an email to podcast@trepp.com. For more info, visit trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening and stay well.